Hey, welcome to Educational Investors Insights. I'm Tom Miller here at Five Plan Partners on the Portfolio Strategies team. Today, I want to talk to you about some bond ratings, how they're rated, what companies rate bonds, and then why it kind of matters. And so, bonds, of course, are debt that are issued by companies. Typically, I'm not talking about government bonds here in this situation, mostly individual companies. And so when they offer debt at certain terms, they essentially pay back the bondholder at an interest rate. The main rating agencies out there are Standard and Poor's, Moody's, and Fitch. And so all of these companies will essentially go through one or two of those providers to get their bonds rated. There's really two main types of ratings. There's investment grade, and then there's non-investment grade, which is also known as high yield, and can also be known sometimes as junk bonds. So the investment grade side of things, these typically offer better terms for the company, and so essentially the investor would get a lower interest rate. The company is able to issue at lower interest rates, take advantage of that. They typically have a better credit rating overall, which if you kind of analyze it compared to what a personal credit rating would be. Of course, you have a higher credit score, you usually get better terms on loans. Same thing works for the companies if they have enough cash on the balance sheet or things like that. Think of a big cap company issuing debt compared to a small cap company without many revenues, things like that. Obviously, the big cap company is going to get better terms and conditions when they issue their bonds. It's also important to be investment grade if they can be, because they would have more ability to be out there to more investors. So there's a lot of terms where pension plans or insurance companies or endowments for colleges, they have certain terms in their agreements where they can't actually buy any bonds from anyone that is not investment grade. And so it gives them some more flexibility and also provides more demand in the market. It's not to say that high yield bonds or junk bonds are bad. They can be essential for a lot of companies just starting out, and they eventually try to build their rating. And so the high yield bonds, the junk bonds, the non-investment grade, that all kind of means the same thing. They essentially issue bonds at higher rates typically, and so that's just kind of how they're rated. That they like I said, they go through Standard & Poor's, Moody's, or Fitch to kind of discuss what their rating will be and what they're able to issue at, the terms, the agreements, things of that nature. And so that's what you're looking at when you're investing in bonds. Is you have to determine, do you want to kind of chase yield a little bit and maybe try to get a higher return for a little more risk, or would you like to be a little more conservative and find something that maybe is a little more financially stable but would pay a lower interest rate? Those are your kind of main core differences there. Standard & Poor's and Fitch typically use a rating system that's very similar. So there's AAA, which would be the highest rated, AA, single A, and then they have triple B. And then after that is kind of the cutoff into the high yield market, where you'll have double Bs and then get into single Bs and Cs, and then D would be a bond in default or a company in default. And then Moody's has a very similar rating system, just a little different. They also have a triple A, a double A, and an A. And then after that, they actually go to BAA, and then they go to BA and things like that. So after BAA would be their high yield rating. And very similar, they anything on the high yield side as you work down to D, which would mean default, is how they rate things. Thank you for joining me today. If you have any questions, please call or email us. And I hope that this helped clear up a little information on the bond rating side of things. And if there's anything else that we can do, again, please don't hesitate to reach out.